We're at the end of the financial year, and if you haven't yet made your tax-saving investments, then it's like we're in the last over of a T20 match and you have to score 36 runs. 6 sixes. But if you're cool like MS Dhoni, then there's nothing to worry about. Let's take it step by step. The first thing that you have to do is to identify the amount of tax-saving investments that you have to make. If you're a salaried employee, you do this by identifying your contribution to the Employee Provident Fund. You reduce the amount for the entire year from 1.5 lakh rupees. We'll get to what that 1.5 is in just a bit. But that's the amount of investments that you need to make. The second step is to make those investments. Look at Section 80C of the Income Tax Act. You have various options for tax-saving investments within that section. You have the Public Provident Fund, you have the NPS, that's the National Pension Scheme, you have a 5-year fixed deposit, you have equity-linked savings scheme, and you also have the National Savings Certificate. Choose from any one of those, and the amount that you've identified in the first step, that's the amount that you need to invest. Now on to the third step, and this is a good choice to make. You can reduce your tax liability by a further 50,000 rupees by investing in the National Pension Scheme. Section 80CCD of the Income Tax Act allows you to do this. And now the National Pension Scheme is a great investment product for retirement purposes, and this is another reason why that is the case. Now in the fourth step, look at health insurance. If you've been depending on your company through the group policy, now's a great time to get cover for yourself because 25,000 rupees is deductible under Section 80D from your taxable income if you buy health insurance policy for yourself. In the fifth step, remember that tax has already been cut through the year or will soon be cut in the month of March. And that's because if you made your tax-saving investment declarations at the start of the financial year, then your employer has not been cutting tax through the year. If you did not make those declarations, however, your tax has been cut through the year, and the only way to get a refund is when you file your returns. Now remember that a great avenue to look at if you haven't declared this is your house rent allowance if you are living on rent. That could save a substantial amount of tax. And in the final step, plan forward. You're in this situation, you're scrambling to make tax-saving investments in the last over of the T20 match because you didn't make those investments through the year. So sit down with a pen and paper and identify how much you need to save next year, and you'll be all set.